एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Namaste. Good morning, everybody. My dear professional colleagues, we have here the most sought out faculty in company law for the final students, Mr. Jayaraman. He will be talking on the topic accepting of deposits and the practical issues in that, and filing DPT-3. He will be talking in detail. We all have so many doubts regarding this, how to treat the acceptance of deposits and what are the rules relating to that. The Companies Act 2013 has brought out so many changes. Still, we are in a confused state now. So it will be clear after the speech by Mr. Jayaraman, and our Vice Chairman Ramesh Kumar will introduce and say a few words about the faculty. Thank you. Over to you.
Thank you, Chairman. Sir, good morning, sir. Good morning to all. CS L. Jayaraman is a fellow member of the ICSI. He's a postgraduate in commerce. He's practicing company secretary for over 31 years and a senior partner in Messrs. Jayaraman Radhakrishna Associates, Company Secretaries, Hyderabad. He was a member of the Secretarial Standards Board of the ICSI, New Delhi for the year 2015. He is the Managing Committee member of Hyderabad chapter of ICSI for 6 years. He is a visiting faculty in corporate laws to several professional institutions in the country. With a teaching experience of more than 25 years, he has taught over 1 lakh students of CA and CS course. He conducts regular classes for all professional courses in Hyderabad, Chennai, Bangalore, Pune, and Ernakulam. He has addressed various seminars, workshops, and conferences throughout the country in all the professional institutes, including CII and Federation of Andhra Pradesh Chamber of Commerce and Industry. With these words, I introduce before you our faculty, CS L. Jayaraman. Over to you, sir. Jayaraman, sir, please take over. Sir.
So, very good morning, my dear professional colleagues, chairman of the Trivandrum branch, other office bearers, chartered accountants, ladies and gentlemen. It is my honor and privilege to address all the August gathering of chartered accountants on this very important topic of acceptance of deposits and the issues which we are facing in filing of DPT-3 with the ROC. Of course, the time limit has now been extended. We have time to file within 30th September. So I thought I will share with the colleagues certain important practical problems which we are facing, and the consequence of not filing will be quite tremendous. Now, quickly running through the historical background, the original Companies Act of 1956 did not have any provision regulating the acceptance of deposits by companies. Very surprising. Then what happened? Over a period of time, many companies started defaulting deposits accepted from the public. The reasons were: one, the deposits which were accepted from the general public were largely unsecured. Second, there was no limits on acceptance of deposits. Therefore, companies were accepting deposits left and right. They were accepting to the extent of even 10 times or 15 times the paid up share capital and free reserves. In other words, they were doing business with creditors' money. And third, there was no control on rate of interest. In order to attract more deposits, since there was no control on rate of interest, they paid a higher rate of interest. And obviously, it is very clear, the more the rate of interest you pay, the more the chances of default. Then, usually deposits were accepted for a short period of time to meet the working capital requirements and all. So that was the reason. And these reasons are far enough that 648 companies in India, including big groups, defaulted in the payment of interest and repayment of deposits. In 1970s, hue and cry was raised in the country, and in 1974, Companies Amendment Act was introduced, and we had Section 58A and 58B. Under that, the Companies Acceptance of Deposit Rules 1975 came into picture. Largely, they regulated all this acceptance of deposits from the public, from the members and others. Now, after that, whenever there was any Companies Amendment placed in the Parliament, the only subject of discussion used to be on deposits. Very surprising. When the 2013 Companies Act was placed in the Parliament, then they hardly discussed in the Lok Sabha about 5 to 10 minutes on that. In that, about 30-40% of discussion only on acceptance of deposits. So what I'm trying to say, the government is attaching too much of importance in acceptance of deposits from the general public, from the members and all. So in light of this background, substantial changes have taken place in the 2013 Companies Act, and also the rules which have been made time and again on that. So in that context, now I thought I'll spend quite a lot of time with you on this. First, I will go very slowly on that. Some of them you already know it, but in order to correlate certain issues, I have to connect all those points. As you are all aware by this time, the word deposit under the rules have not been defined. Rather, it is negatively defined. What deposit includes any receipt of money by the company as a loan or deposit or any other form, but does not include. So instead of defining what is a deposit, they try to define what is not a deposit. In other words, if you look at the liability side in the balance sheet, other than share capital, other than reserves and surplus, probably every item will come under the definition of deposit unless you bring them under the exemption. So what they have tried to do is they try to define what is not a deposit. So therefore, the onus of proof to show in prosecution is just to you yourself has to tell in very clear terms, I fall under this category of exemption, and hence it is not a deposit. Therefore, if this kind of definition is not there, what can happen is we may have some features and try to say it is not a deposit. So quickly running through what is not a deposit, then these rules will not get attracted. First, money received from the central government, state government, local authority, statutory authority, all those things. I find three logic in not including this money which you received as loans. I'm not talking of subsidies received from the government. We are talking of loans, advances, and other deposits from the government. Why they are not deposits? Three reasons. One, usually when the central government, state government, or even local authority or statutory authority give any type of loan or deposits, they are usually secured over the assets of the company. In other words, the government knows how to take care of their money. Second is, usually nominee directors will be appointed by all these people since the amount of loan which they give is quite huge. And third is, the rate of interest which these people may charge may be higher and rate of interest which may not come within the parameters of rate of interest under the company's acceptance of deposit rules. Anyway, what the government thought is, let the company regulate only the money received from the general public as such. Therefore, this is the logic, the 3 points on which government thought all this money coming from the government, we know how to regulate it. There is no need to regulate under this company's acceptance of deposit rules. Hence, the exemption provided. Second, money received from the foreign government, foreign international banks, multilateral financial institutions and all. Here, the reason is they are already regulated under the Foreign Exchange Management Act. And plus, to some extent, they are regulated under the FEMA, external commercial borrowings also. So the government thought, since it's already under the regulatory mechanism, there is no need to regulate these kind of money which you receive under the Companies Act once again. Then the money which you received as a loan from bank, public financial institutions, same logic. The logic is they charge a high rate of interest, and second, they are secured over the assets of the company, and third, they appoint a nominee director on the board. Therefore, they probably know how to take care of all this money which they have received. The next one is money received as commercial paper. And commercial paper guidelines have already come. So there is proper regulation there itself. So they are regulated already by Reserve Bank of India. So it is not a deposit there. Then money received by a company from another company, very interesting, very important. A company, whether private or public, when they receive deposits from another company, it will not be regulated under this section relating to deposits. For the simple reason, they are already regulated under section 185 and 186, where intercorporate loans and deposits from companies are already regulated. So there's no need to regulate here. So if you are receiving any money from another private or public company, this company receiving money, they are not deposits. Now, there's one very interesting point. Does this money received from another company, if you receive money from a foreign company, are they not regulated? If you really look at the word company, if you had used the word body corporate, I would be very clear. Foreign companies also will be exempt. But then since they have just used the word company, in my opinion, and I've clarified from Reserve Bank also, that any money received from a foreign company, to some extent, they are already regulated by permissions by RBI under Foreign Exchange Management Act. Therefore, they are also exempt. So in other words, even though they have not used the word body corporate, a company receiving money, any deposit from an Indian company, whether private or public, or from a foreign company, whether holding company, subsidiary company, or any foreign company, to some extent which they are regulated under the Indian Companies Act, they are also exempted. They don't come under the definition of deposits. Now, why I am focusing more on this exemption list is, you will be surprised. I'll be telling this point later on. In DPT-3, in the radio button, one return you are to file, even in case when you are an exempted deposits. That is the reason why we should focus also more on this list of exempted deposits, which may not come under the rules and regulations. Then one interesting point is, what about the money received as a loan or deposit by the company from a LLP? Even though LLP is a body corporate, LLP will not come under the definition of money. Therefore, there's a case law on the subject that this private or public company, when they receive any money from a LLP in the form of a loan or deposit, it will come within the purview of the Act. They are not exempted. This point we'll have to remember this very clearly. Then the major change, which we are all aware of it. Previously, what we used to do, we used to take a lot of money in a private or public company in the form of share application, secure share application, debenture application. The word used is securities, and mostly we used to get share application. Now we used to keep the share application for some period of time. Then this obviously the money will be used for the allotment of shares. But in some cases, certain approvals are not required or certain provisions of Companies Act we are not complying with, then we try to return back. Now this lacuna government has found out. What they are telling in very clear terms, hey, whenever you receive money in the form of share application, that money should be used only for allotment of shares. For any reason, if you refund the money, it is capable of attracting the definition of deposit. Therefore, when you receive the share application money, now there are other sections in the Companies Act which regulate the share application money received and allotment of shares. Quickly running through that section, private placement guidelines have also come, then also rights issue, public issue guidelines. All the money which you have received as share application under the Companies Act, you have to allot within 60 days. Unless that minimum subscription, keeping in a separate bank account, all those guidelines you have to follow. So within 60 days, you have to allot the shares. For any reason, if you are not able to comply with the statutory provisions, including SEBI guideline, and you have a situation arises where you have to refund, you have to refund it within 15 days after the expiry of 60 days. Now, so 60 plus 15, 75 days. Within 75 days, if you have not refunded that money, it will acquire the character of a deemed deposit right from the date of deposit. So this is where we have to be very careful. I repeat, these rules will apply to private company also. In private company also, private placement guidelines are now applicable. So we are all under probably an impression that in private company, you can take share application money and keep it for long. So they will attract the deemed deposit concept. You have to be very careful. And also this, for the purpose of this rule, any adjustment of amount for any other purpose will not be treated as refund. So if you adjust also, it will acquire the character of a deemed deposit. So summarizing this point, if you have taken the share application money, fine. But you must allot the shares within the time period, within 60 days. In other words, if you're not allotting within 60 days, maybe another 15 days within which you can refund it. So within 75 days, you are neither allotted nor refunded. That money will acquire the character of deposits. Now, these I would call it as deemed deposits. Now, the rules are not clear. When such deemed deposits happen, how about compliance of the provisions of these rules? Because it will take retrospective effect. A reasonable interpretation will be, at least from today, you have to comply with the provisions of the rules and all that. Next. This is a very important point. Lot of confusion in the minds of the professionals. Now it is very clear. Come on, I'll divide into two categories. Private company receiving money from the directors and others. Public company receiving money in the form of deposit or loans from the directors and others. First, I will discuss private company. I am not discussing money received by a private company from members. I'll come to that later. Now, a private company receiving any amount of money in the form of deposit or advances from the director of the company is exempt. They are not within the rules. You can pay any rate of interest to the director. You can take for any period. They are not under the control mechanism. So a private company can receive any money in the form of deposit or loans from the director of the company without any control mechanism. And also relative of the director. Relative as defined in the Companies Act, not the general word relative under income tax or any other place, any other legislation. So quickly recollecting, in a private company, relative is members of which you are there, plus a spouse, that is husband and wife. If he is a director, his wife. If she is a director, her husband. Then sidewards, brothers and sisters. Then upwards, parents, including adopted parents, steps, children and all, parents. Then come down, children with spouses. So in other words, now you have got only a small list of relatives. So brothers and sisters side, the spouses, their children are not covered. Grandparents and great-grandparents are not relatives. Grandchildren, great-grandchildren, they are not relatives. Only son and daughter and spouses are relatives. So in a private company, you can take any money, you come under the exemption. in the form of deposits from the directors and relatives of the directors. They are also exempt. Now, next comes public company. So in a public company also, whether listed or not, any money received from the director of the company is exempt, not from the relatives, not from the members. If he is a director of the company, he is exempt. So in a private company, money from the director plus relatives are exempt. In a public company, money received from the director of the company is exempt. But in both the cases, they have to furnish a declaration that they are not borrowed funds, that these funds which they are giving to the company as a deposit or loan, they are not borrowed from others. It is out of their own funds. And I'll come to this point much later. This you are to disclose in the board's report. This you are to also disclose in the financial statements. I'll come to that later. Auditor's duty is to see this particular point. Right. Next, this is very interesting. We are all probably under the impression if a company issues debentures, whether it is a private company or public company, they are exempted. They are not deposits. Not at all. Not at all. Look at the language. I'll split up the whole thing and we'll try to look into this slide. I'll try to split up the whole thing. First, if it is secured debentures, I'll come to unsecured debentures much later. Non-convertible debentures much later. First, if it is secured debentures, secured over the assets of the company, they are not deposits. They are exempted from deposit, subject to lot of conditions. First condition, the secured debentures, they must be secured over first charge on the assets of the company. This is a very interesting development. Now, practically what happens, let us see. Usually, when a private or public company takes a term loan from a bank or financial institution, they will insist on first charge on the fixed assets of the company. Second, when this company takes working capital from a bank or financial institution, they will have a first charge on the current assets plus second charge on the fixed assets of the company. Then, when normally, the practice had been earlier, normally when they take money from others, it is usually a tendency to give a third charge, or even for deposits also, to give a third, debentures also, not deposits, debentures also, to give a third charge over the fixed assets of the company. That is not possible now. Now what he is saying, you might have issued secured debentures, but it should be secured over the fixed assets of the company, and they should have first charge over the fixed assets, not second charge or third charge. In fact, I remember some 25 years back, Reliance Industries, when he issued convertible debentures and other debentures, he used to have a third charge. All that is gone. So when you issue a debenture, secured debenture, you should have a first charge or pari passu first charge along with the other secured people. Very interesting. And the second, intangible assets, you cannot create a charge. So intangible assets like software, patents, trademarks, copyrights, brands, marketing rights, all those assets will not be considered. It will not be considered for the purpose of creating a security. And third is, one small concession he has given is that even for tangible assets, the assets, the fixed assets value, you need not take the book value, you can go up to market value. That is a great comfort level for us, because usually land, buildings, plant and machinery, the book value may come to about 20 crores, but the market value will go up to 50 crores or whatever it is. But that valuation, that market value also has to be done by a valuation expert. So summarizing it, if it is unsecured debenture, it is not exempted. It will come into the definition of deposit. What is exempted? Secured debenture. But lot of riders on that. In secured debentures also, first, it should be completely secured over the assets. Second, you should have a first charge or pari passu first charge on those assets. Third, intangible assets will not be considered while you give a security. Fourth, the security value will be taken on the basis of market value of the assets, right? Now, what about the convertible debentures, which may be unsecured? Yes, unsecured convertible debentures, convertible into equity shares at a later period of time, they are exempt. You don't have to comply with the rules of deposit. Unsecured convertible debentures, but one rider is that has to be converted into shares within a period of 10 years. So very interesting guidelines. Then what about a debenture which is non-convertible, which is unsecured? I told you it will come within the definition of deposit. So you have to comply with the debenture rules as well as the deposit rules. So no point in issuing non-convertible unsecured debentures. However, one small exemption is given. Unsecured non-convertible debentures issued by a listed company, they are only exempt. So in other words, if there are 11 lakh companies in India today, roughly speaking, around 9 lakh companies are private companies, around 2 lakh companies are public companies, about 22,000 companies are only listed companies. So just leaving this 22,000 companies aside, for all the other public and private companies, if they issue non-convertible unsecured debentures, it will acquire the character of a deposit. So only for a listed company, listed, here one the very interesting wording he has guessed. Listed company means not only the shares must be listed on the stock exchange, these debentures also must be listed on the stock exchange. For them only, they are not a deposits and they are out of the rule. So very, very complicated and very clarity is there in the exemption. Then amount received from the employees not exceeding annual salary as a security deposit, non-interest bearing. This is slightly different from what was there in the 1975 rules. Now, usually what happens, certain type of employment, we take security deposit from the employees. For example, cashier job or certain job where they are dealing with some liquid assets of the company. If they run away, it becomes a big problem for us. Therefore, we insist on certain financial security. Earlier, what we used to do, we used to take, say, about 1 lakh or 2 lakhs or whatever it is, and we used to pay some interest to them. After all, he is putting that money in the company, we used to pay interest. Now he says, okay, you take secure, what are the riders? You take money from an employee as a secure deposits, not security deposit, but that should be interest free. If you are paying any interest to the employee on the security deposit, it will acquire the character of a deposit. And what is that money which is exempt? Only up to the annual salary. If his salary is around 25,000 rupees, maybe around 3 lakhs, not exceeding 3 lakhs, you can take, and that is not a deposit. And that too, you cannot pay any interest on that. Then non-interest bearing received on trust. Earlier, the wording was any money received on trust or in transit. That word transit has been omitted. And if you have received some money on trust, that is on behalf of someone, you have to return it back. In that also, no question of payment of interest. 1 rupee if you pay interest, either in a private or public company, it will acquire the character of a deposit. Then these are all the very interesting points. 1, previously, certain type of goods or most type of goods and services, we take some advances from the customers in the ordinary course of business. In fact, I remember Tata's, when they manufactured the nano car and all that, crores of money they received, which escaped the definition of deposits because they said we are not returning back the money to the customer. We are taking as advance and tomorrow we'll manufacture cars and give it to them. Now there are a lot of riders. In the ordinary course of business also, you are a manufacturing company or service-oriented company. If you take any money from a customer or any other person, that money, whatever you receive, should be adjusted against the goods, against the services rendered within 1 year. That is the rider. So if you keep the money for 1.5 years or 2 years, that money will acquire the character of a deemed deposit. So advances received from in the ordinary course of business for the purpose of supply of goods, you should not return the money for supply of goods and services. You have to adjust that supply of goods and services within 1 year. Or for any reason, you are not able to adjust, please return back on expiry of 1 year within 15 days. If you return, excellent, you don't acquire. If you don't return within 1 year, then it will acquire the character of the deposit. In other words, it indirectly tells you, you cannot have an arrangement for the supply of goods on credit or services with a credit period of more than 1 year. Very interesting. If you have a credit period of more than 1 year, then it will acquire the character of a deposit. Of course, if there is a disputed deposit, you're going to court of law, then probably this period of 365 days will not apply. Next. What about immovable property which you are receiving? See, he doesn't make any distinction between real estate company and other company. Any company where you for the sale of immovable property by the company. So naturally you take advance. You all know the transaction in immovable property. Usually we just take some advance and the agreement to sell will be entered. Later on the sale deed will be prepared. So now the agreement to sell, if you enter and take some advance for sale of immovable property, then that 1 year period, no restriction, but there should be an arrangement or agreement. Well, there are some people, some chartered accountants in the north and some people in Andhra Pradesh have seen, they have taken the stand that this agreement should be in writing. And this agreement for the sale of immovable property should be registered. I find these are all extended meanings. Nowhere it is written. He never said. The word used is under agreement or arrangement. It can be oral also. So long as you can prove the terms and conditions in the court of law, it need not come within the strict definition of agreement in writing or even registered. So therefore, if you have received some advances against sale of immovable property, it need not be done within 1 year. You can extend it, but it should be an understanding. So you should not return back. Ultimately, you have to adjust against that immovable property sale. Next one, advance received under long-term projects for supply of capital goods. So for long-term projects, again, he did not specify the 365 days. Again, he is not talking of any agreement. So capital goods, it could be movable property or it could be movable property. Capital goods, sometimes I am a machinery manufacturer. So therefore, I manufacture the machinery. I take some advance because made to order, it could run even in lakhs or crores of rupees. So there, the time period within which I should manufacture and deliver, those 1 year period and all is not there. But there also, if you cancel all those orders, then it may acquire the character of a deposit. This is the very important points. So long-term contracts. So you receive from the customer for supply of capital goods, 1 crore, 2 crores, 30 lakhs, 40 lakhs, whatever it is. And if they are cancelled, we don't have any solution here. Next, security deposit for the performance of contract for supply of goods and provision of services. Yes. Security deposit. Usually, when we appoint wholesalers, dealers, retailers, agents, and all the market intermediaries, obviously will take some advances from them. They are all exempted. So you can pay high rate of interest to them because they are business advances, security deposit in the form of security. But for subcontract, there must be a contract for supply of goods and provision of services. So in this category, the wholesalers, dealers, distributors, agents, all these market intermediaries, usually company takes some money from them. And why they are not advances is because the goods and services of the company are under their control. So they know how to take care of their money. Probably the government thought not to bring under the definition of deposits in this. Next. When it comes to, in all these cases, if you refund it with or without interest, then it will acquire the character of a deemed deposit. One more rider here said, sir, actually I've taken some advance and we have to take some statutory approvals, maybe RB approval, maybe some sectoral approvals and all we have to take. We did not get those approval, so we are refunding. Still it will acquire the character of a deposit. Because the money does not have necessary permission or approval, it will still acquire the character of a deposit under the rules. So he has tightened up all this very clearly. These are all indirect ways and means which professionals and industrialists are using to bring the money inside. And the penalties and all is terrible. This is the reason why all the professionals, chartered accountants and company secretaries must focus on all these small issues. Then, next. Then you are providing some guarantees, performance guarantees, warranties, and obviously you take some advance. So, okay, that guarantees, it will be for 5 years for use. So you can take advances for supply of warranties, goods warranties, guarantees, as per the business practice are up to 5 years, whichever is less. That will not be treated as an advance. Then any advance received and allowed by sectoral regulator. For example, SEBI regulates this brokers, sub-brokers, underwriters, and portfolio managers and things like that. Reserve Bank of India regulates some NBFCs, some companies. Similarly, for insurance companies are regulated by IRDA. These sectoral regulators, if they are permitted you to take some kind of advances, you don't have to comply with the rules. And the next very interesting one is, this is for newspapers, TVs, electronic media and all. So what they normally do, they enter into long-term contracts with certain people to advertise this newspaper or in TV. So they take advances. So there is no period limitation. You take it for 5 years or 10 years because you get at a very low price. The slots are booked for you. So those people, when they take that money, it will not be treated as deposits. See how stringent he has brought it. It is not so simple like whatever money you receive from the customer or from the dealer, distributor, they are not deposits and all that. You have to fit into any of these exemption categories. Next. Then, some of us are probably under a very wrong impression when the promoters of the company, when they bring some money inside the company, they are all exempted. No. This is unsecured loans which is brought inside the company by the promoters will not come under deposits. So they can pay higher rate of interest and all. They don't come under the rules, but subject to 3 riders. 1, on their own, the promoters must not bring the money. Some additional term loans or working capital or some other loans should have been sanctioned by the banks and financial institutions. And the banks and financial institutions put a rider. When we give you 5 crores, you bring in 1 crore, something like that. So in pursuance to such stipulation imposed by the bank financial institution, the promoter should have brought that money in the form of unsecured loan. And this loan should have been brought by the promoters themselves, not from relatives, friends or associates and all. And third, and this exemption is not forever. Once the term loan is repaid or the working capital is paid or whatever it is, once the contract with the bank financial institution comes to an end, then this promoter who has brought in the unsecured deposit or loan should be repaid. Otherwise, it will acquire the character of a deposit. So this is only an extraordinary case. Then, of course, now money received from these people, they are regulated elsewhere. Money received from a chit fund, money received from Nidhi company, collective investment schemes, because they are already regulated by SEBI. So all collective investment schemes, SEBI prohibit them. But if SEBI has permitted, since they are already regulating it, there's no need to once again regulate under the Companies Act. Then convertible notes. You are brought in a convertible note for issued by a startup company. This facility is not for all the companies. Startup company. Who is a startup company? We'll see. There's a definition separately for that. This startup company, if they have issued convertible note, convertible into equity shares within 5 years and all, and that amount of convertible note is not less than, not less than the particular amount. So then they are exempted. Single strength they should. Similarly, these are all already regulated by SEBI. Your domestic venture capital funds, infrastructure trust, mutual funds, alternate investment funds, all that they are regulated by SEBI. So these are not deposits. And also, so how detailed they have put it. Why I have spent so much time is, the chartered accountant, the statutory audit cannot be very casual because they are not deposits. You have to identify and then write in the DPT form. I'll come to that much later. Right. Then this whole rules obviously will not apply to banking company, non-banking finance company, and housing finance company, for the simple reason similar kind of rules are there put by Reserve Bank of India. They're already regulated by Reserve Bank of India. Hence, this will not apply to them. So this was the substantial discussion on what is not a deposit. Now, let me come to the main area first. After the 2013 Companies Act, you are all aware, the definition of a private company was slightly changed. A private company previously used to have 4 restrictive clauses. The number of members restricted, now of course 200, then restriction on transfer of shares, then no allotment of shares can be made to general public. They cannot accept deposits. This 4th one has been relaxed. Now in the 2000 Companies Act, I repeat, private companies can accept deposits from the members, not from the general public, from the members. And if private companies accept deposits from the members, they come within the regulatory framework. Of course, some exemptions are there, but some regulatory framework they come. In other words, when a private company accepts deposits from the members, the rate of interest, the period, all those control mechanisms you have to follow. You have to give a deposit receipt. You have to maintain a register of deposits. Otherwise, the penalties violation is quite terrible. So I'm now coming. We'll divide acceptance of deposits by private companies, public companies separately. So I repeat now, private companies, when they accept deposit from the directors and the relatives, they are exempt. We already discussed. Now, private companies can accept deposit from the members. There's a small rider here. Not that first you will accept the deposit and then make a member. Before you accept the deposit, they should always, they should have already been a member of the company. Then they can accept deposits. One resolution in general meeting has to be passed. Ordinary resolution in general meeting. How much this private company can accept? Previously, we had different limits. Everything has been streamlined. You can accept up to 100% of paid up capital, free reserves and securities premium. Fair enough, net worth. But in net worth also you cannot consider all the capital reserves and all. Free reserves. So paid up capital, free reserves, securities premium. In other words, debt equity must not exceed 1:1. Of course, not considering the borrowed from banks, financial institutions. Fair enough. If your paid up capital, free reserves, including securities premium is about 2 crores, you can take deposits from the members, another 2 crores. In other words, it's not 2 times, 3 times which is allowed. In other words, still you are not allowed to do business with creditors' money. So 100% deposits you can accept from the members in case of normal private companies. Up to 100% of paid up capital you can accept. Second, in case of private company, yes, newly set up startup private company. It should be a private company. It should be newly set up. It should be a startup company. What is a startup company? There's a separate definition. I'm not going into that. You have to register and get a certificate as a startup company from the Ministry of Industry. If you go to Industries Ministry, you have to fulfill the requirements. They'll give a certificate. So a startup company, which is a private company, can accept deposits from the members, any amount, for the first 5 years. Any amount, I repeat, from the members only. It's nothing to do with the paid up capital. Third, a private company can accept deposits, any amount, subject to 3 riders. What are the 3 riders? 1, it should be a pure private company. It should not be a subsidiary of a public or private company, or it should not be associate company. In other words, indirect public money should not have come in this private company. And who are usually the members? Individuals. Second, how much you have borrowed? Debt equity does not exceed 2:1, or you are borrowed from banks, financial institutions, not exceeding 50 crores, whichever is less. A small level private company where the borrowings from bank financial institutions do not exceed 2 times the debt. Third, even that borrowings from the bank's financial institutions have not defaulted in the repayment. So I'm talking of law-abiding company. So if these 3 riders you comply, even a private company can accept from the members any amount without any restrict mechanism. Now let's look into 3 exemptions, 3 cases very carefully. Put it this way: startup company, which is a private company, and the first 5 years, any amount they can accept. Second, a private company which is able to comply with all the 3 riders. Pure private company, it's not an associate or subsidiary company, or it has not borrowed more than twice the paid up capital free reserves from bank financial institutions, and even this bank financial institute borrowings, they have not made any default. Come on, you also accept any amount as deposits without any restriction from the members. And third one, come back to the first one. Third one is, if you are not able to comply with the 3 riders, you are just a private company. How much you can accept from the members? You can accept only up to 100% of paid up share capital, free reserves and securities premium. So this guideline is absolutely clear. Now the most important point I want to tell the chartered accountants, even in private company, when you accept money from the members, the DPT-3 you have to file with ROC. I am coming to that much later. So we are all the impression that the DPT-3 has to be filed only when you accept deposit from the general public and all. Not at all. I'll explain all that much later. So in the private companies also, you have to file DPT-3 with ROC, right? This is the acceptance of deposits by the private companies subject to these limits, only from the members. In all the cases, you have to file the DPT-3 and also you have to pass ordinary resolution. So private company need not issue any other document. Now let me move on. Acceptance of deposits by public companies. I will divide into 2 sections, section 73, section 76. Section 76, I'll come to that much later. A public company also can accept deposits from the members. General public will discuss later. A public company can also accept deposits from the members by passing a resolution. How much they can accept? 35% of paid up capital, free reserves and securities premium. So a private company, normal private company, can accept 100% of paid up capital, free reserves, whereas a public company can only accept from the members 35% of the paid up capital, free reserves. All public companies. But some more procedural compliance you have to comply in case of these public companies. They have to issue one circular in DPT-1. In the Old Companies Act, it's not prospectus. In the Old Companies Act, we used to call like text of advertisement, statement in lieu of advertisement, something like that. All that is gone. This is nothing but some summarized points taken from the prospectus, because we don't want even the members in a public company to blindly put the money in the company without knowing the financial position of the company. So this DPT-1 need not be filed for private company, but in public company, before you accept deposits, even from the members, you are to file DPT-1 with ROC. This DPT-1 contains some financial position of the company, and another point is credit rating is compulsory. See how costly it has become now. For private company, there is no credit rating. For public company, even from the members, I'm not talking of general public, even from the members, if you accept deposits, that credit rating is made compulsory. So apart from the contents in DPT-1, number of depositors, amount due, default, and other particulars, so that you have to file. So that any member who wants to deposit money in the company can inspect a DPT-1 which you have filed with ROC, and so that he can involve himself in informed decision-making process. And this DPT-1 has to be filed with ROC within 30 days from the date of circular, and then you can accept deposit. Then, apart from that, for a public company accepting deposit from the members, 20% of the amount of the deposit maturing during the financial year. Now, financial year is 1st April to 31st March of next year. So, let us say 2020-21 is the financial year. On 1st April 2020 itself, you must work out and see how much is the total amount of deposits with interest are to pay during the financial year. In that, 20% must be kept in a separate account, deposit repayment reserve account. Just as debenture redemption reserve account, you have to create the deposit repayment reserve account, and that money correspondingly you have to keep in liquid assets. Similarly, 20%, this is only not to provide security, this is only to ensure liquidity, so that any time I can just sell those assets overnight and then pay the money as and when. This is only to ensure liquidity, so that on the due date, you are not stuck up with your cash flow problems and all that. This has to be made. Usually, this has to be done within 30 days. But because of COVID, because of the virus problem now, they have extended this period up to 30th September for the current year. Okay? Because of this COVID 2019, because of the virus, for the current year, normally within 30 days, you have to create this reserve and invest that money. This year, you can do it within 30th September. I repeat, this is also there for public companies accepting deposit from the members. That amount maturing 20%, you have to keep in a separate account and you have to invest. Then, one more rider for public company. If you have already accepted some deposits from the members, and if you have defaulted the older deposit, whatever you accepted, you have to rectify the default. And the rider is not only you have to rectify the default, for 5 years after the rectification of the default, you cannot accept any fresh deposits from the members. Quite a lot of riders are there. One interest you are defaulted, you might have rectified, but then that black spot is on the company. Therefore, after 5 years from the rectification only, they can accept further deposits. So these are all some additional points one has to look into. And therefore, I said now you can accept deposits 2 types: secured deposits, unsecured deposits. In the old Companies Act, whatever deposits you accept, even from the public or members or whatever it is, used to be usually unsecured. Now the special feature now given is, just like debentures, you can accept even secured deposits as well as unsecured deposits. So when you are accepting deposits, they are unsecured, you have to specifically state that it is unsecured. If you are a secured deposit holder, fine. Then you have to create the security on the assets which we have already specified. Right. Now, come to the main section 76. Certain bigger public companies, not necessarily listed, certain bigger public companies can only accept deposits from the public. So government has regulated this acceptance of deposit from the general public. Hardly 15,000 companies, 10 to 15,000 companies only are able to comply with this requirement, and they come within the limits. So this is covered in section 76, eligible companies. So I have now finished section 73, members in a private company, members in a public company. Now come to section 76, he says, who is that eligible company? It should be a public company, net worth not less than 100 crores. My God, 100 crores is your paid-up capital free reserves and all. Let me use a thumb rule. When you're talking of debt equity of 4:1, say 100 crores, we are roughly talking of project cost of around 500 crores. When roughly a return on long-term investment also, if we take about 20% or so, we are talking of a turnover of around 2,000 plus crores. Very big companies only can accept deposits from the general public. So net worth should be not less than 100 crores or turnover not less than 500 crores, public company. Then they are to pass special resolution in the general meeting. Other cases only ordinary resolution, here special resolution, and that resolution, anyhow, MGT 14, you have to file with ROC before you can accept deposits. Of course, ordinary resolution is enough in case the total debt so far does not exceed the paid-up capital and free reserves. Otherwise, special resolution. Right. These companies, how much they can accept? 35%, but again, there is a division. 10% of the paid-up capital free reserves and securities premium you can accept from the members, and the remaining 25% you can accept from the general public. That's all. A lot of restrictions they are brought in now. Now, a public company has two options. Don't come to section 76 at all. Just remaining section 73, you accept 35% of paid-up capital free reserves from members. Or you are a public company, bigger companies fulfilling the criteria of eligible company. Then what you do a breakup. 10% you take. It's not 35% plus all this. 10% you take of the paid-up capital, share capital, and all free reserves from the members. 25% balance you can take from the general public. Here the riders. Since you are taking money from the general public, of course, government company complying with the requirement directly, since the government itself is shareholder, they can borrow up to 35% of paid-up capital. Now, here also DPT-3 that circular giving all details. The DPT-1 you have to file with ROC. The difference between DPT-1 filed in a public company for members and a public company receiving money from the public is that DPT-1 not only you have to file with ROC, you have to publish in 2 newspapers, one in English, one in the local language, and put that details the website of the company. And it shall be audited. They should have a circulation, and the audited audit certificate also should be there that the figures whatever you are giving is correct. Auditor has to state that they have not committed any default in the repayment of deposits. So auditor certificate also has to be enclosed with the DPT-1. Now, credit rating is compulsory. I told you, both for public companies from the members or outsiders, credit rating is compulsory. And credit rating also, you should get at least minimum investment grade rating from any of the credit rating agency, approved credit rating. If you get less than that, you cannot accept the deposit. These are all to safeguard the investors. And then when you have issued a secured deposit, you have to create a security, the charge and all within 30 days on the assets of the company. Then other small requirements of deposits, which will apply to all the cases, private company, public company and all the cases. Quickly run through some of the points before I take a lot of time on DPT. Repayment should be done as per the terms and conditions. Once you have accepted, you cannot change the terms and conditions. Then, very interesting point here. Suppose for some reason the company has defaulted the repayment of interest or repayment, it may be unsecured. If it is secured, fine, deposit trustees will swing into picture. If it is unsecured also, there is another remedy available. Any deposit holder can go to tribunal, company law tribunal, and tribunal can give a direction. Can the company go and argue before the tribunal? Sir, they are unsecured. Why you are interfering? No. Your tribunal has got extraordinary power. They are aware that they are unsecured over the assets of the company, still the tribunal can give a proactive direction. Tribunal can say, you please sell all these assets and see that you please return back the deposits or interest all within this period of time. And you don't follow the order of the tribunal, extraordinary punishment. Directors are personally punished. So this is another option available to deposit holder to go to tribunal. Then the deposit repayment reserve account, which I was telling you, should not be used for any other purpose. You have to keep in a bank account. That money you use only for the repayment of deposits as and when they become mature, due for payment. Now come to the period. As per the rules, all the companies which are allowed to accept deposit, you can accept only for 6 months to 36 months. That's all. Less than 6 months you cannot accept. More than 36 months you cannot accept. So that means this is only a short-term funds used by the company for the working capital purpose. Obviously, you cannot use for long-term purposes. So the period is from 6 months to 36 months. That is 3 years. However, up to 10% of the paid-up capital share capital you can accept for the period more than 3 months within 6 months. This for very short working capital. No company can accept demand deposits, and because that becomes a banking business, or repayable on demand or a certain period of time, all that is not permitted. Normally the deposits from 6 months to 3 years, but in case of emergency, up to 10% of paid-up share capital free reserves, you can accept for repayment after 3 months to less than 6 months also. What is the rate of interest? Now, the maximum rate of interest, if you come within the definition of deposit, I am not talking exempted deposit. If you didn't come the definition of deposit, whether you accept from the public or from the members, the maximum rate of interest which you can pay is that rate of interest which Reserve Bank of India has fixed for non-banking finance companies. I checked up the present RBI rate of interest for NBFC is 12.5% is what they have prescribed. I was given to understand they're going to reduce this limit also. But as on today, maximum rate of interest which you can pay, it can be less than 12.5%, but it cannot exceed 12.5%. And brokerage, how much you can pay, that is also controlled. Because the more the brokerage you pay, you get more money. So brokerage is restricted only to 2%, and the company can pay 0.5% to the brokers as expenses if they have incurred expense. Now, one very important point is brokerage cannot be paid if you have accepted deposits from the members, whether it is a private or public company. Brokerage can be paid only when you accepted deposits from the public. And you cannot pass on the benefit of 2% to the public. You have to pay that brokerage only to genuine brokers. You are paying to some other person is a violation of the rule. You should be registered with SEBI and all, and you should be doing this brokerage business as such. Then, once you have accepted deposits, during the period for which the deposits is going on, you cannot change the terms and conditions, particularly to the disadvantage of the deposit holder. You cannot change the deposit trust deed, deposit insurance contracts, all those things, nothing. Of course, deposit insurance they have deleted now. That is not yet come into effect because the no insurance company is prepared. I'll come to that later. So once you have accepted the deposits from the members or from the outsiders, the terms and conditions cannot be altered to their prejudice or disadvantage. For example, today you accepted deposits at say 12.5% rate of interest. Tomorrow the RBI may raise the rate of interest to 13%. So for the remaining period, can you give high rate of interest? Yes, permitted. You cannot reduce the rate of interest. You can increase the rate of interest. So this is another point one has to keep in mind. Then when you have issued secured deposits, already told you, come on, they have to create the security. Look at one more rider. Now what companies are doing? Some portion, they are saying it is secured deposits. Some portion is unsecured deposits. Now, companies just to confuse the deposit holder or create a better impression. They take the stand. They take the stand. Sir, 10% of the deposits are secure. 90% are unsecured. Now, how will the public know? So what he has done, when you are going for a combination of secured and unsecured deposits, the unsecured portion should not be more than the secured portion. In other words, secured portion should be 50% of the total deposits. Look at the language. And I already told you security cannot be created on intangible assets. So when you are going for, say, 2 crore rupees as deposits, total put together, secured and unsecured, the unsecured portion, come on, should not exceed 1 crore. Secured portion can be more, but unsecured portion should be less than 50% only. Another rider. And also, already I told you, the valuation should be on the secured portion. Charge has to be created, first charge or pari passu charge, and you can do it in the market value of the assets minus intangible assets. And if you have issued secured deposits, just like in the debenture, you have to create a deposit trust and you have to appoint deposit trustees and all that. And you have to file the deposit trust deed in DPT-2 with the ROC before issuing that investment. And who can be the deposit trustee? Just like debenture trustee can be. So anyone can be, but this director, KMP, and all those people who are indebted to the company or who have got material procurement relationship or who entered to guarantee, they should not be the trustee because they are under the influence of the company. We want a person who can call a spade a spade. Therefore, these people cannot be. And also relatives. And also, if you want to change the deposit trustees, consent of all the directors are required. At the meeting of the board, consent of all the directors required. And if the company has an independent director, his consent also very much is required. Now, let's go to one register which you have to maintain. Any company which has accept deposits had to maintain one register. And that register previously is a small rider. A company accepting deposits, if you are not accepted deposit, you will not maintain. You find in the Companies Act this kind of wording. There are around 32 registers to be maintained. Every company shall maintain a register of members. Every company shall maintain a register of directors. So that means whether there is entry or not, you have to maintain. Every company shall maintain register of buyback. But here the wording is every company accepting deposit should maintain. So if you are not accepted deposit, there's no need to maintain. Right. One register giving all the details. So now they are prescribed. PAN number you have to take for each deposit holder, irrespective of the quantum of deposits you are accepting. And also all the details has to be entered in the register, including the you have to issue the deposit application form, deposit receipt. All those details have to be entered in these registers. And also TDS, if it is applicable, you have to write those details. When is the interest you are paid, maturing period, when, and if it is secured, when you have created the security, all those details have to be written in the register concerned. And the register, they are brought in par with the other registers. It has to be authenticated, signed whenever entry made by the director or secretary or authorized purpose. Not that the person sitting in the department will just put the signature. It should be authorized and it should be preserved for 8 years. In other words, he is treating this register as a part of books of accounts of the company. So it's not that you keep a register and keep it in some corner. It has to be preserved for 8 years. These are in summary the rules, the major rules. Small one, I would have eliminated it. Okay. Now, I told you a public company can, a private company can accept deposit from the directors and the relatives. They are not deposits. Similarly, a public company can accept from the directors. They're not deposits. But there we saw the details are to be given in the director's report. And now he also says, they are to be disclosed in your financial statements. In notes on accounts, the auditor must see that whether it is a private or public company, when they have received from the directors All those details are to be given in the notes on accounts, how much money they have received, what are the terms and conditions, even though they are exempted deposits. And apart from the rate of interest, if you have defaulted in the repayment of deposits, overdue rate of interest you have to pay 18% per annum. If you have defaulted and all, this is a special rate of interest you have to pay 18% per annum. Apart from the 12.5% for overdue deposits, you have to pay 18%. So this in short is the rules. Now I'll spend about half an hour about the DPT-3. Lot of confusion in the minds of particularly chartered accountants, of course, to some extent, company secretaries and all. Now, you all are aware, DPT-3 is online filing which has to be made. You find in DPT-3 4 radio buttons. Radio button 1, button 2, button 3, button 4. In simplified form, let me explain. There are 4 separate forms put under one heading. I'll put it that way. You should have made 4 separate forms. Anyway, all this is called DPT-3 form only. But DPT-3 form, when you say radio button, there are 4 separate portions of the forms. I will take the questions in the end. I'll just finish the whole thing. So now we have got 4 radio buttons. Radio button 1, radio button 2, radio button 3, and radio button 4. Right. In other words, let us now start with the presumption there are 4 separate forms. You have to file filing fees separately for each and every form, but they are all called as DPT-3. First, radio button 1. It is one-time return, and once only you have to file this form, covering for a period 1/4/14 to 31/3/19. Last year they introduced particulars not considered as deposits. Lot of details you have to fill up. Then radio button 2 is the return of deposits. If you have accept deposits from the members or public, you have to file. Then radio button 3, particulars of exempted deposits. This is what I'm telling you. Even if you are not accept deposits, a private company or public company, exempted deposit also you have to file DPT-3. I'll come to that. Then radio button 4, particulars of transaction not considered as deposit. This is the height. You are trying to find out a violation. You are not coming within the definition of deposits. You are not saying that it is exempted deposits. They are trying to find out that you have to give in radio button 4. So there are 4 separate forms given in one form itself. You have to file radio button 1, radio button 2, radio button 3, radio button 4. These 4 separately I will explain. First, radio button 1. This was introduced last year. So one time you have to file. I repeat, this form has to be filed by all companies in India. Whether you are a private company, public company, you have to file this form, because the government wants to find out and know from the balance sheets and all whether you have violated the provisions of the Act. So every company other than government company should file one-time return. Outstanding receipt of money are not considered as deposit. For 5 years, balance sheet you have to check up. 1st April 2014 to 31st March 19, not 2020. This was last year you have to file. In DPT-3, within 30th September 19. Please see, I repeat again, this was to be filed last year. So last year, now the department has released that many companies have not filed even today. Don't worry. Now, all of you are aware that, I'll come to that. Okay, so this one-time return, the last date of filing was 30th September 2019. For a period of 5 years, those particulars you have to file. And at that time, if you have filed, there was no filing fee for this particular form. If you don't file with or before 30th September, filing fee and late fees are there. But now you can take advantage. I don't know how many are aware of it. There is one scheme now. Companies fresh start Scheme 2020. I'll just briefly tell you about the scheme. All private and public companies today who are not filed some old returns, one-time opportunity is given to them. Now, the last date, without additional penalty, additional filing fee, you can file it now. I repeat, please take advantage of this company's Fresh Start Scheme, FFCS 2020. The summary and main point of the scheme is any company, this 12 lakh, 11 lakh companies in India, if you are not filed any old returns, maybe 10 years old, 15 years old, annual return, balance sheet, all any forms, you can file it now without penalty or additional filing fee. The original filing fee, if you file, one-time filing fee, 300, 400, 500, you can file it. So please take advantage of that. But this will not apply for some authorized capital you are increasing. Then for charges like that, it will not apply to them. And also the MGT 14, more than 1 year, some restrictions are there. So based on that. So coming back to this part, this radio button one-time filing return, which I said every private company, public company has to file. If you have not filed it earlier, please file it now before 30th September 2020 and with the filing fee. Now, this return has to be supported by auditor certificate about the figures. Now, some people are taking a stand. No, sir, the audit report is already there. No, it doesn't matter. A separate, the format is released by the CA Institute. In that format, you have to take auditor certificate and you have to file it. Now, there is one issue which had come up. What about those companies, private or public companies, where there are no entries to be passed? There is no entry at all. Nil returns they are filing. The one-time return, radio button 1, nil return they are filing. They don't have a deposit. They don't have exempted deposit. They don't have any other things. Nil return. Should I file it? Now, different ROCs are taking different contradictory views. Hyderabad ROC in one of the seminar took a view, if there are nil, particulars are nil, you need not file. But Karnataka ROC took a different stand. So this you please confirm. In my opinion, even if nil return is there, please file it. It doesn't make any difference to you. Filing fee also is not there. Now, anyhow, your time up to 30th September. So this is all the story of DPT-3 radio button 1, one-time return. Every year you don't have to file. One-time return covering for the period of 5 years. Please file it. Now come to DPT-3 radio button 2. This, if you have accepted deposits, to whom it will apply? Private companies taking money from the members, the 3 categories of members. Public company taking money from the members or from members and public. Those coming within section 73 and 76, every year they have to file this returns as on 30th June. The position is as on 31st March, 3 months time is available. But now this year, because of this COVID, they are allowing up to 30th September. So this you have to pay filing fee. This is not given free at all that. This you have to pay filing fee and you have to file the return. In DPT-3, this is the return of deposits. You accepted deposits either from the members or from the general public or whatever it is. Auditor certificate, you have to file DPT-3 with the filing fee before 30th September. Radio button 2, you have to file. This is also only for those who have accepted deposits. If you have not accepted deposits, don't have to file. Now come to radio button 3. This is also return of deposits. Radio button 3, 1000 times I'm repeating, exempted deposits also you have to file the return. Whether it is a private company, whether it is a public company, exempted deposits. At the first 1 hour of my session, I focused more what is not a deposit. So even if they are not a deposit, you have received money as security deposit from dealer distributors or from the employees or from the directors. I repeat, those exempted deposits, they are to be filed in DPT-3. Otherwise, penalties are terrible. So DPT-3, it is clarified that Form DP3 should also be filed for return of deposit to particular transaction considered as deposit by both other than the government company. So the exempted, particulars of exempted deposits also you have to file there. As on 30th September this year, exempted deposits with the return in DP3 along with the filing fee. Now, DPT-4 radio button. This is, you are not coming under the exempted category. Then you are not return of deposit, but still you find some entries there. What are those entries? You have to file in radio button 4. Obviously, this is also filing fees and all. Your time up to 30th September. Obviously, if you have some entries here, you will be in trouble. Department is going to take a stand. They come under the reflection of deposit. Anyway, if you can explain them, fine. Otherwise, most of them will take a stand. I don't come under radio button 4. So these are the 4 radio buttons where you have to file. So summarizing it, DPT-3 has 4 parts, 4 separate parts. You can file any one of them also. So DPT radio button 1 is one-time return, which you would have filed the last year. If you have not filed it, you file it now. Second is the return of deposits. You accepted deposit private or public companies from the members or from the general public, section 73 and 76. You have to file it in radio button 2. Radio button 3 is exempted deposits, those cases, those details also you have to file. Radio button 4 is extraordinary case. I don't think anyone would come within the category. This is the returns you have to file. All cases, now time is available. Please take advantage of it. I don't think they may extend further. By 30th September, you please file it this year. And for the, I repeat again, all the cases, separate filing fees you have to pay. Now, in the CARO report, in the CARO 2020, which has now come, what the auditor in a private company or public company is certifying in the CARO report. In the CARO report, he says, in case company has accept deposits, whether following the complying the directive, this is the wordings which you have to certify in the CARO report. The provisions of, look at the language, section 73 to 76 are relevant provisions of the Companies Act and rules framed thereunder has been complied. Or the order passed by erstwhile CLB or tribunal or any court or any other tribunal, and if they are not complied, the nature of contraventions has to be stated. So when you are making a statement, you cannot, you know the consequence of, disastrous consequence of giving a wrong report in CARO report. So CARO report, whether it's a public or private company, you are making a statement as a part of the audit report that these companies have complied with section 73 to section 76. That is one thing. Another thing is, what is the consequence? Of course, this may not directly attack the auditor. What is the consequence if section 73 to 76 have been violated? It's not just the repayment of interest or violation, repayment of interest or repayment of principal. Any violation, including report in the DPT-3, one of the case laws have said that this is broad enough to cover. Hey, look at the kind of penalty. The company will be punished with fine not less than 1 crore or twice the amount of deposit, whichever is less, which may extend to 10 crores. 1 crore, even magistrate has no, once it is proved you have contravened, company has to pay a fine of 1 crore or twice the amount of deposit, whichever is less. Comes the climax. What about the officer in default? Non-compoundable offense. Imprisonment, which may extend up to 7 years. Even I checked up misstatement in prospectus, the worst kind of crime which normally a person commits is only 2 to 3 years imprisonment. It is equivalent to fraud. And the officer in default, the company secretary, the CFO, all these people, the officer in default, the KMP, imprisonment up to 7 years and fine non-computable, not less than so 50 lakhs to 2 crores. And the story doesn't end there. If it is proved the officer in default has contravened the provisions knowingly, willfully, liable for fraud under 447. Imprisonment minimum 2 years to 3 years to 7 years. So I don't know. The government has taken this deposit section violation very seriously, and the bigger acts is on the chartered accountant, the statutory auditor. Responsibility is put on them to verify, because you have to report all this in the Caro report. And I thought I will do some more homework. In case you have violated the provisions of section 73 or 76, particularly non-payment of interest or non-repayment of principal, look at the other connections with the other sections where you have to face the music. If you have violated the provisions of deposit, you cannot issue bonus shares. Section 63, if you read carefully, a company which has violated the provisions and still the violation is continuing, stop your bonus issue. And the section 66, same language, you have violated the repayment of deposits, reduction of capital cannot be affected by the tribunal. Section 70, buyback of shares cannot be done so long as the default is continuing. The climax, many of us have not concentrated. If there is a default subsisting as on the date in the repayment of deposit or principal in public or private companies, you cannot pay dividends. These are all missing our attention. It will be a blatant violation if you declare dividend and the deposit provisions have been violated. Then the other one I checked up, 164(2)(b), which heated debate is going on. You are a director of a company and you have not repaid the deposits and all, it will amount to disqualification. So you have to vacate the office. You have to vacate the office as director in all other private public companies. Now with the clarification, the defaulting company can continue. Then you have to vacate the office for a period of 5 years. Look at the connected sections. And one more issue before I take up questions and all that. Class action suits. Look at the connection which they have established. Class action suits. Now, you are all aware, class action suit. Previously, that legal entity concept was there. A member or deposit holder can only sue the company, and company in turn will sue the officer or auditor and all that. Now, the legal entity concept has been set aside. Now, in case of fraud, misstatement and all that, the members and deposit holders can directly sue the company directors and auditors. Class action suits have been notified now. Not only shareholders, 100 deposit holders or 5% of the total number of deposit holders, whichever is less, or a company who owes 5% of the total deposit, that deposit holder. What is the allegation? Management are conducting the affairs in not in the interest of the company or member or deposit holders. They can file in the tribunal for damages, not just compensation alone, damages. The class action suits. For what they can sue? The auditor and the audit firm for improper misleading statement. Silence also will amount to fraud. So in the Caro report, if you make a wrong report, come on, it is your class action suits can be directly filed. Auditor, directly the deposit holder can sue the auditor. It need not be rooted. The Satyam Kaputa's fraud, LIC alone lost 1,000 crores. So see the chain connections which the auditor and the audit firm for improper misleading statement, fraudulent wrongful conduct, experts and other people can be sued. Of course, one small clarification, they have said that in case the auditor is being sued by the deposit holder, the concerned auditor, the concerned partner of the firm who has signed, he is only liable, and also the firm is liable, not the other auditors. So within the time which is given to me, so I think I have completed fairly all this. I'll be glad to take questions from the participants, from the chartered accountants. So I'll be another half an hour. Any questions? Please unmute your and then ask.
So we have questions in the chat box, sir.
Hello?
Do I need to read for you?
Pardon?
Shall I read for you?
Yeah, please.
We have
Yeah.
questions in the chat box. Okay. So first question is from Benny Matthew. His question is there any restriction on accepting intercorporate deposits from an unrelated company by the receiving company?
No restrictions whatsoever. If it is another private or public company, you can directly accept any intercorporate deposit. It is not regulated under this, but it is regulated under section 185 and 186 that you have to comply. And you are aware in section 185, certain, for example, if it is a public company, you cannot accept deposit from the directors of the lending company or holding company, relative of such director, partner, firm. And also in 185, you are accepting from another private company in which the director is a director or member or body corporate or a body corporate accustomed to act special resolution. So what I'm trying to say is those procedural compliances under 186 you have to comply. The matter has to go to a meeting of the board, unanimous approval, financial institutions approval, then you can accept. So to answer your question under section 73 and 76, no special requirements are to be complied.
The next question is from P.A. Krishna Kumar.
Yeah.
The question is,
I think the voice is not clear. Yeah.
sir, can you hear me properly? Can you hear me?
Now okay. Yeah.
The next question is from P.A. Krishna Kumar. The question is, after filing CFSS form, will the disqualifications on directors be listed?
After filing?
CFSS form, will the disqualification on directors be listed?
Will the, no, I'm not getting it.
After filing CFSS form.
The DPT, which form you are saying?
Company fresh start scheme form. Will the disqualification on directors be listed?
No, in the CLSS form you are filing it. That's all. No more prosecutions. That is the advantage. Yes, you can use that CLSS form and you can file it. So after that, no prosecutions.
Okay. The next question is from P.A. Rajiv.
Pardon?
Next question is from P.A. Rajiv, and the question is, advance collected from clients by stockbroker towards margin for shares purchase or to be used for further purchase, whether it can be treated as security deposit.
Some audio problem is there.
Shall I repeat? I will repeat once again. Advance collected from clients by stockbroker towards margin for shares purchase or used for further purchase of shares, whether it can be treated as security deposit.
No, you can treat it. Yes, I got it. You can treat as security deposit because it is the contract for supply of goods and contract of services. Treat as deposits, exempted deposits. Yeah.
So,
security deposit are exempted. Yes.
Any questions from others? Any questions? I hope the questions is over. Shall we conclude, sir? Jayaraman, sir.
Yes, fine.
Okay.
Unless, of course, I think whatever is told to me, I have completed it. So because I was told 1.5 hours and half an hour for question and answers. Yeah. So I'm glad that members have understood the whole thing. Yes.
Thank you, sir. Thank you so much for your informative session. Jayaraman sir, being a faculty for law, is a regular faculty of ICA Tirunelveli branch for crash courses. We thankfully remember him when last year when we contacted him without any hesitation. He come over here and took the classes. This December also he came here while taking the class. Some problems happened. After that, he went back and he completed the classes through online also. So we are very much thankful to Jayaraman sir for his support towards the branch. This time when we contacted for this also without any hesitation, he has accepted our invitation, and thank you so much, sir, for your support for
and before I conclude, one point I would like to tell. I've given the phone number and that slide. So any of the members who would like to have that, you can get from the institute all the slide presentation, whatever I told. So I'll be glad to, any member can contact me. My email ID is ljayaraman@rediffmail.com. My phone number also I have given in that slide. So I'll be glad to assist the members in case they find any problem in filing the returns and all that. So once again, thank the Trivandrum branch for giving me this great opportunity to address the August members. Thank you, one and all.
Thank you, sir. Thank you, sir.
Thank you.
We thank all our participants for joining with us. Thank you all once again. Thank you very much. Have a nice day.